We are live. This is your life insurance 2023 series. This is going to be part. Yeah, we're live. So this is going to be our life insurance January 2023 series. This is going to be part 3 of 4. And so the the idea for today is essentially to first have a recap of the things that we went over in parts 1 and 2, and then get off into the topic for today. So within the next 15 minutes, we're going to go over just a recap, and then go over the bird's eye view of how life insurance fits into retirement planning. And so the goal is to essentially give you, the business owner, a plan to get up the mountain, but more importantly, a plan on how to get down the mountain. And so the piece that we're going to be looking at today is from one of the big four accounting firms. They're known as Ernst and Young. So I'll be sharing my screen with you. So we got about 14 minutes to get through the content. So let's start off by just recapping parts 1 and 2 of the series. So part 1 was about how large companies would buy policies on their employees. And this just essentially give them cash to use on the balance sheet, right? They could use that cash to offset any losses for the year, or just as an overall hedge for anything that happened in the business or within the business market space. Moving on to part 2, we looked at how the smaller business can essentially utilize that same strategy. And that strategy was called golden handcuffs. And with the golden handcuffs was you would use a life insurance policy that would accrue cash value that you could use to bonus out your employee, your key employee. You could use that as compensation package or as an incentive for the employee to stay with you. And that was because there was a great resignation, is what the experts are calling it, post-COVID. So recruiting, retaining, and rewarding key employees was the focus of part 2. And as we look at part 3 of the live stream, this one is going to be tying it more so, tying up some loose ends to where how would life insurance actually make sense for the business owner himself. So we're just going to go ahead and get right into the content for today. So first, we're going to take a look at our accounting firm that did the piece for today. And so the accounting firm is known as Ernst and Young, otherwise known as EY. So just going to read this here for you. Ernst and Young, right here, provides audit, consulting, tax, business risk, technology, and security risk services and human capital services worldwide. The company, one of the big four accounting firms, dates back to the earliest 20th century. So you can think of them as, well, according to Forbes, one of the major accounting firms on the planet, right? And so what Ernst and Young does is provide consulting services for businesses and taxes and business risk. So, legitimate company, been around over 100 years. They merged in 1989, so that's probably of a little importance. Um, and what you're going to see is that, if I highlight this right here, I'm just going to refer to Ernst Young as EY from now on, just to abbreviate. EY employs over 200,000 people and operates in over 150 countries. So they're a massive mover and shaker. They have a ton of information just on the business environment for many companies. And so this takes me to the piece that I want to focus on today. And this is how investors, and in particular business owners, can use a life insurance chassis to increase their, or say, better their retirement planning outcomes. So, to give you a breakdown of what this article is about, EY essentially, they take a peek under the hood of different investment portfolios and different outcomes. And what they did in this study was they took a look at 5 different scenarios, and they determined which one has the best outcome for someone that wants to plan for retirement. So this is going to be one of the problems, or the brief that they notice right here. By 2030, gaps in investors' retirement savings and needed protections are projected to exceed hundreds of trillions of dollars in the United States. All right. And so, just to kind of summarize, to give you a taste of the menu, what they're saying, this is EY, permanent life insurance and deferred income annuities with increasing income potential outperform investment-only approaches in our analysis. That statement is somewhat a lot to metabolize. What they're saying is that insurance products and insurance chassis outperforms investment-only approaches for retirement. So this is going to be EY's data in terms of the shortfall or the gap. So what they're saying is that by the year 2030, there will be a $240 trillion retirement savings gap and a $160 trillion protection gap. It's a lot of money. And so insurers are uniquely positioned to address these gaps. And so essentially what EY is stating is that there are a percentage of Americans that are going to be underinsured to start. And then on that same coin, they're not going to have enough money saved up for retirement to actually ensure that they don't outlive their money in retirement. And so what they look at in their survey is that we explore how 2 products can be used. Let's see if we can highlight this. How 2 products can be used to meet investors' savings and protection needs. Permanent life insurance, abbreviated PLI, and a deferred income annuity with increasing income potential. We're going to abbreviate that as a DIA with IIP. So the insurance chassis, we'll call it life insurance, and the deferred income annuity, essentially what they're saying right here, when you integrate permanent life and the deferred annuity into a retirement plan, you are provided with value beyond an investment only strategy. So, what EY did was a Monte Carlo analysis of 1,000 different randomized scenarios. And so they're looking at a range of factors, which is listed here: interest rates, inflation, equity returns, and bond returns. And so there's a full report, and this is going to be the report here. So if you would like access to this 18-page report, if you like to comb through the details with a fine-tooth comb, just send me a private message if you're watching this here on LinkedIn. If you're watching this on any other platform such as Facebook or YouTube, you can schedule a virtual coffee chat with me or message me on the appropriate platform, and I'll get that to you. So, moving along, because we're coming down to the final 4 minutes here, there's 5 scenarios that EY looked at: investments, term protection. The main thing is that the permanent life insurance with the annuity outperformed the investment only strategy. So let's go ahead and get to some of the main benefits. So if you're watching this on the screen, I'm going to highlight this here for you. Permanent life insurance tends to provide superior returns over fixed income in long-run scenarios, while the term premium acts as a drag on portfolio performance. Permanent life insurance loans act as a buffer against market volatility, as well improving returns since the investor does not have to sell and realize losses on investments. To break that down in an easy to digest term is that with the permanent life insurance, you take risk off the table, right? So you have there's more certainty in your retirement plan. Because we're down to the last 2 minutes here, we're going to get to one of their summary points. I'm going to highlight this here for you. The results point to the value of permanent life insurance and income annuities in a retirement plan. An integrated approach can give comfort and peace of mind to retirement investors by providing legacy protection, tax-deferred savings growth, and guaranteed income for life without sacrificing their present lifestyle. Insurers can use these products to strengthen their relationships. So this is EY, third-party source, one of the largest accounting firms on the planet, saying that if comfort and peace of mind in retirement are something that you desire, then you're going to want to integrate permanent life insurance and an income annuity into your portfolio. And just a brief summary, we're going to highlight the piece from EY. And by the way, this came out in Q4 of 2022, so this is recent. And I'll read this to you and tie up the loose ends because we're down to the last minute. Investment-only approaches do not deliver as promising returns as those that are combined with permanent life insurance and deferred income annuities with increasing income potential. An Ernst Young analysis shows, although there are distinctions to consider depending on whether more retirement income or legacy value is desired, allocation levels should be approached with care. So, ladies and gentlemen, that wraps up our show for the day. So to summarize, EY took a peek under the hood of retirement planning for the business investor, and what they found was that using an insurance chassis is superior to just using an investment only strategy. So if you come across someone in your day to day that owns a business, in particular a pass through entity that is looking for a way to essentially guarantee some income in their retirement planning, you can send me a private message here on LinkedIn and we can connect and we can take it from there. So, as always, I appreciate you guys tuning in. Take care and have a good one.